Good afternoon, and thank you for holding. Welcome to Mills Live to discuss the earnings of the third quarter of 2023. If you need simultaneous translation, this tool is available on the platform. Simply click the interpretation button at the globe icon on the bottom of the screen and select the language you prefer, Portuguese or English. For those listening to the conference in English, there is the option to click on Mute Original Audio. We inform that this video conference is being recorded and will be made available at the company's IR website, where you may find all materials of this earnings release. During the company's presentation, the microphones of all participants will remain on mute, and afterwards we will begin the questions and answers session. Note that the information contained in this presentation and the forward-looking statements that may be made during this conference call relating to the company's business prospects and projections are based on the management's expectations regarding the future of Mills. Forward-looking statements are not a guarantee of performance. They involve macroeconomic conditions, market risks, and other conditions, other factors. I will now turn the floor to Sérgio Kariya, Mills CEO. Thank you. Good afternoon, everyone. It's a great pleasure to meet you again to comment on Mills' third quarter of 2023's earnings. We had great results this quarter, which we will comment on with you now. On slide 3, we present the highlights of the period. In this quarter, we presented earnings growth in all business units, demonstrating our resilience and the consistency of our growth strategy. Consolidated gross revenue reached 396 million BRL in the third quarter this year, up 22% from the third quarter of last year. The growth was significant in all business units, with an increase of 21% in rentals and 31% in formwork and shoring compared to the third quarter of 2022. Regarding the rental fleet, we had a net addition of 1,500 machines and equipment when compared to the third quarter of 2022. We continue to grow at a strong pace in heavy rentals, with a more than 3.5 times fleet increase in 1 year. We ended the quarter with more than 11,500 pieces of equipment in the fleet and confident that our technical excellence, culture focused on the customer journey, capillarity, and scale are Mills' strengths and make us stand out in our business. We posted record EBITDA of almost 180 million BRL and a margin of 51% this quarter. Net income was 67 million BRL with a margin of 19%. We continue to have room on our balance sheet for growth with leverage of 0.6 times net debt over adjusted EBITDA, and we are certain that low leverage enhances our use of opportunities in the short and medium terms. Investments totaled 120 million BRL in the third quarter this year, up 47% compared to the second quarter of 2023, due to higher investments in heavy rental in the quarter. In this unit, we continue to make investments and signing new contracts while evaluating strategic opportunities for equipment acquisitions and M&As to accelerate growth. The ROIC, return on invested capital, recorded in the third quarter was 21%. The slight drop in ROIC is a reflection of the high investments made over the last few quarters. Mills has a high ROIC that derives from the good management of its fleet and operations, focused on high profitability and capital efficiency. We balance ROIC and cost of capital to achieve the greatest economic value addition to our business. In this quarter, we announced the payment of interest on equity for fiscal year of 2023 in the amount of 17 million BRL, totaling 54 million BRL in the year. Mills was also upgraded by Fitch from a rating of A to A+, with a stable outlook reflecting the expectation of a continued gradual increase in its operating cash generation and profitability. We also promote our customers' care for the environment, and we continue to advance on this front. Our greenhouse gas GHG inventory received the gold seal from the Brazilian GHG Protocol program, which corresponds to the highest level of qualification granted to companies that demonstrate compliance with all transparency criteria in the publication of their inventory. And we started the development of the company's emissions reduction project with a commitment to the SBTi in line with the Paris Agreement. The largest fleet of electric and hybrid vehicles in Latin America will be complemented with projects such as the transition of the energy matrix in our branches. We increase the use of biofuels, among other actions mapped out to consolidate our actions to reduce emissions and continue to evolve in our sustainability journey. Next, Carol, our CFO, will comment on the financial aspects of the quarter. Good afternoon, everyone. Karia, thank you so much for the opening remarks. Starting on slide 5, we start by commenting on the results of the combined rental business unit, which accounted for 84% of our revenue in the third quarter of 2023 and includes both light and heavy equipment. We have grown our fleet by 15% over the last 12 months, and the current replacement value is of 4.2 billion BRL. The increase in the fleet was due to the strong growth in heavy vehicles this quarter. This quarter, the focus on light vehicles was on readjusting the fleet mix to better meet demand. Mills is already a reference in the rental sector, being a benchmark for elevating platforms and an absolute leader in the rental of this equipment. We believe that leasing is a service that adds value to our customers. We have primary maintenance services, experienced and trained technicians focused on the needs of each customer in order to always offer the best solution. On slide 6, we demonstrate the evolution of our diversification strategy, seeking greater resilience to Brazilian economic cycles. The rental business unit serves customers from a variety of industries, as we demonstrate in the chart on the left side of the slide. The breakdown between the sectors remains quite fragmented, and it's worth noting the greatest penetration in the agribusiness segment, a resilient sector of the economy, which today totals 9% of rental revenue. We are diligent with the distribution of our portfolio, also at a healthy level in the third quarter of 2023. We have more than 9,500 clients, and approximately 75% of our revenues are dispersed, which reduces the risks of a portfolio concentrated in a few clients. We are constantly concerned with increasing our client portfolio and the share of wallet in each of them, reinforcing the importance of our long-term relationship. The yellow line market is deep, and we are certain of the potential for consolidation and growth of this market. We believe in the buy-to-rent conversion enhanced by our value proposition, which is to offer our customers the most attractive option through the understanding of their needs, greater agility in service, productivity, uptime, and security. Let's go now to the financial highlights of the rental business unit on slide 7. Compared to the third quarter of 2022, our net revenue grew 22%, mainly due to the entry into the yellow line in September of 2022 and a better mix of equipment in light machines. Sales revenue accounted for 6% of the business unit's net revenue in the quarter. We continue to adapt our light machinery fleet with the aim of optimizing the life cycle and mix of our fleet. Adjusted EBITDA grew 25% compared to the third quarter of 2022 and 9.2% between quarters, reaching an EBITDA margin of almost 50%. The company has been implementing several initiatives to optimize expenses and efficiency gains for greater profitability and value generation. We also improved our EBITDA margin compared to the third quarter of 2022 by 1.2 percentage points. We understand that we have even more opportunities for cost and expense dilution as the yellow line business becomes more relevant, and with the growth in the number of branches and our continued efficiency management of costs and expenses. Moving now to the earnings of formwork and shoring, as we had predicted in our last communications with the market, we have been observing a good period and relevant growth in the performance of this business unit, mainly due to the pipeline of infrastructure works and the resumption of the civil construction sector. Net revenue increased 33% versus the third quarter of 22, mainly due to better prices. When we look at adjusted EBITDA, we see a value 64% higher than in the third quarter of 22, with an increase of 11.2 percentage points in the EBITDA margin year-on-year. Quarter-on-quarter, we had an increase of 8% in rental revenue, keeping the margin in line. On slide 11, we show Mills' consolidated results. Compared to the previous year, the 23% increase in net revenue was mainly impacted by higher rental revenue, which increased 24%. Compared to the previous quarter, this growth was of 3% and 6% in rental revenue, mainly due to the growth of the heavy rentals unit. Adjusted EBITDA was 30% higher compared to the previous year, and the margin was 2.8 percentage points higher, totaling 51%. We remain certain that our pillars and its strategy form a solid foundation for Mills' growth. On slide 12, the chart on the left shows that our net income reached 67 million BRL in the third quarter of 23, 3% higher than in the third quarter of 22. This variation is mainly a result of the increase in EBITDA in the third quarter of 23, which was offset by the increase in gross debt, which increased financial expenses, and by the increase in the fleet, which increases depreciation. The chart on the right side shows the high cash flow generation in the period, with a significant increase compared to the third quarter of 22 and the second quarter of 23, totaling 208 million BRL in the quarter. We have a resilient business model supported by a cash-generating portfolio and financial diligence to drive our growth. To conclude, on slide 13, I present our capital structure, highlighting our strong balance sheet and low indebtedness level, which allows us to capture growth opportunities. We closed the third quarter with gross debt of 961 million BRL, 579 million in cash, and 381 million BRL in net debt. Our gross debt is composed almost entirely of debentures and has 85% of its payments planned for the long term. We also maintained our attractive average cost, totaling CDI plus 2.3% in the third quarter of 2023. Leverage reached 0.6 times net debt over adjusted EBITDA in the last 12 months. This assures us of another quarter of fulfilled covenants. We have room to leverage the company and continue to grow in our segments. Once again, we ended another quarter proud of the team's work and prepared for the coming periods. Paccaria, you have the floor.
Thank you, Carol. I'd like to take these final moments to comment with you a little bit of what we're seeing for the future. Next year, 2024, we will continue our growth trajectory. We will open new branches to support our operations throughout Brazil. Our customers deserve a close and efficient service which guarantees the support that they need. We'll continue to preserve our leadership by seeking continuous growth, organic or inorganic. Our customer is always at the heart of everything we do, and we seek to integrate our sustainability trajectory with our business. We work tirelessly so that our customers have productivity gains with a fleet that provides maximum security and does not let the operation stop. The penetration of platform use has room to grow. The leasing of yellow line machines in Brazil should gain more strength as users realize the value of having their fleets leased. And the government's growth acceleration program, PAC, also catalyzes demand for our services.
Our scale gives us purchasing power, our maintenance keeps the equipment in its best condition and with high uptime, and our commercial team is trained to always think about what the customer needs and offer the best product at the best price. Thank you again for your interest in our company, and from now on, we're available to answer your questions. We will now begin the questions and answer session. To ask a question, click on the Q&A button at the bottom of your screen and write down your name, company, and language. When announced, a request to enable your microphone will appear on the screen. Then you may turn your microphone on and ask questions, and your camera as well if you wish. If you prefer, write your question so that the operator can read it. Let's go to our first question from André Ferreira, sell-side analyst, Bradesco BBI. André, we're going to open your microphone for you to ask your question. Please go ahead. Good afternoon, everyone. Congratulations on the earnings, and thank you for taking my question. I'd like to go over 2 points with you. First, the fleet remains stable quarter on quarter. I'd like to know whether you can add details, whether there was an increase in the heavy line, the focus, the CapEx focus in terms of net addition. And the second question is about formwork and shoring. We're seeing that it's an increase, a very relevant increase in the average price. And if you see an possibility for increase, or what do you see? Those are the questions that I have. Thank you. Thank you, André, for your question. We made some adjustments to seek productivity improvement, especially in the light machinery business units, as we mentioned in March of this year. So we sold some of the equipment, adjusted the mix. You could see some improvement there in terms of yield and productivity in the third quarter. For the heavy equipment, we continue to grow. 100% of the CapEx made this quarter was in the heavy line, and we have growth. If you look from the inception when we started, when we acquired Triengo in September last year, we almost quadrupled the size of the fleet, and we are continuing in this movement. So our use rate is high, and we're open to opportunities. As for formwork and shoring, the average duration of contracts has been extending. It's always been a little bit longer, 12, 13 months. Now we're increasing that period to 14, 15 months, considering that the construction works are becoming slightly more complex. And the closing at the end is much higher than what we closed last year. So what you're seeing since the beginning of last year and throughout this year, quarter on quarter, you're seeing an improvement in this perception in terms of pricing. There's still room for more growth. We see a share still coming this fourth quarter and the remainder for next year. So there's still room for that to continue rising, not in the end when the new contracts are closing, but contracts already signed. And as we migrate older contracts leaving our portfolio and the new contracts coming in, you're going to start to see a perception of price improve and productivity as well in formwork and shoring. Very clear. Thank you. Next question, Fernanda Reck, sell-side analyst, BTG. Fernanda, will enable your audio for you to ask your question. Please go ahead. Good afternoon. Can you all hear me? Yes, Fernanda. Great. Thank you for taking my question. It's actually 2 questions on our side. I'd like to talk a little bit more about capital allocation for next year. In the release, you make it clear that the focus will be on yellow line, but maybe if you can tell us a little bit more of what you're expecting in terms of growth for the segment. We had about 70% of CapEx for rental allocated for this segment, I believe. Is it along those lines, 70-30 that you're thinking about? And the second point, the competitive environment for elevating platforms. We saw that Luxon, French company, came in and made two acquisitions. And although the companies don't focus on the elevating platforms, they do have platforms. So how do you see the entrance of this French competitor? If you feel any yield pressure, and looking at other players, if there's any players bothering you in platforms. Thank you. Thank you, Fernanda. Carol, want to talk about CapEx? I'll start with capital allocation then. So, Fernanda, in terms of capital allocation, that should be the ratio, as you mentioned, maybe even a little bit higher for heavies. So the focus on yellow line is for growth of the operation. We have a smaller CapEx in yellow line to renew the fleet, but most of the CapEx is for the growth of the operation. And in light machines, we have CapEx that is going to be smaller, between 25 and 30%, but focusing on the adjustment of the fleet mix. That's a little bit of what we did this quarter, as we've been talking when we talked to you over the last few months, reinforcing our mix, especially in the larger machines in the market. So, Fernanda, on your second question about the competitive environment, yes, Luxan made two acquisitions, but the two companies that they acquired are more focused on generators, power generation. But of course, we're looking very closely at their next moves. And overall, we see it as something positive because Luxan knows how to do their math. I mean, in terms of education and rental rates, the company is very disciplined. And I believe that that helps reinforce this concept of capital allocation, return on invested capital. So that reinforces and strengthens somehow that side of things. The competitive environment, there's some room, but nothing as significant in terms of new entrants and players. Of course, every now and then, new players come in the rental market, but I don't think there's anything material that impacted our results. We remain very focused on the expansion of the penetration of this concept, on opening branches, the maturity of the branches we opened in previous years. And I think we've been harvesting results, and the results are also in the increase of yield comparing the first and second, but also this third quarter in 23. Excellent, Carol. Thank you for your answers. Next question, Gabriel, sell-side analyst, Itaú BBA. Gabriel will enable your audio for you to ask your question. Please go ahead. Hello, Carol. Good afternoon. Thank you for this opportunity. I'd like just a quick follow-up in the yield, just because we saw progress there in the rental numbers with the fleet at a stable level quarter on quarter. You made it clear that the focus is to increase and improve the mix of your fleet to optimize the operation, but just to understand quickly how you should think about this breakdown in the progress of yield, looking at use rates over price. And the second price point, you talk that the yellow line is at around 80%. Do you consider that an earn rate, considering the receivable over the demobilization of new assets or assets that are pending to be implemented, or should this level be different? Thank you. Okay, so starting with the yield of light machines, light rentals, in terms of yields and rental rates, it's almost stable quarter on quarter. So we have not been feeling any strong pressure on yields and prices. What we've done is just we sold part of the assets that were with a lower use rate, and we were seeing less demand for those types of equipment. So we balanced it off a little, and we've been feeling more demand for heavier products or heavier equipment, especially projects, construction, and higher maintenance that have been demanding heavier equipment in the light rental sector. In the heavy equipment segment, we expect it to run slightly above what we are today, where we are today. I think there's room. So considering we work more with long-term contracts, we start to be able to plan things better. We want to run at around 85% in terms of use rate of those assets. I think I covered everything. Is there anything that I left? No, it is very clear, Karia. Maybe just a quick follow-up. Would it make sense for us to think about a use rate of close to 100% for yellow line, considering long-term data? 100%, I think it's unlikely. What we're going to start doing now, we had from inception when we acquired Triangel, we bought some machines, some models, and this year we had more focus as the contracts were signed. We're closing our portfolio. We're seeing some opportunities for the coming months, especially for next year, for us to plan the acquisition or the purchase plan, the schedule. So since we have more experience and we have a stronger pipeline, we are able to predict future demand a little bit better according to what we have in negotiation. So we would be able to be more assertive by buying ahead of time, having more bargaining power with our OEMs. So we want to balance this a little bit more for 2024. And then with that, we end up not getting to use rates of 100%. We want to run above where we are today, but at around 85%, I think it's quite likely considering the strategy we're going to follow from now on. Very clear, Korea. Thank you. Next question, Felipe Lemon, sell-side analyst, Citi. Felipe, we'll open your microphone for you to ask your question. Please go ahead. Good afternoon, Karia and Carol. Congratulations on excellent earnings. My question would be about this diversification portfolio that you're following. It's clear that you've been able to expand your portfolio in action, generating excellent results so far. And the earnings this quarter shows that the company still depends a lot on the construction segment, directly or indirectly, in your rental revenue generated by construction. And what about formwork insurance? It's still very representative in the top line. If so, could you give us more color about the segment where the company wants to get more strength and where you want to focus for 2024 to increase even more in agribusiness for the top line, for example? Felipe, I think the company's strategy in the last few years has been basically to bring more resilient sectors of the economy, more perennial industries, and longer-term contracts. For example, if you look at 6, 7 years ago, we had almost 60% of the company's revenue from the civil construction sector, and at 2014, it was 90%, and today it's at around 30% of our revenue. So 70% of the company's revenue comes from different sectors, different industries. And we're coming with a strategy of trying to bring more perennial, more resilient industries. That's the example of agribusiness. If you look at the second quarter of last year, 2022, agro was 1%, and today it's 10%. So these actions will continue to unfold as the company's strategy. And the second point about the resilience and reduction of the cyclic nature of the company, the focus that we have, that's what the focus that we have for long-term contracts. So if we look at the heavy rental segment, we do not make any offers. We do not bid when the contracts are short-term. We always seek long-term contracts, 12 months or more. Our average duration of contracts, it's close to 3 years for heavy rentals. That's what we're seeking, to balance the turnover that we have for light rentals with more perennial contracts, bringing more resilience and predictability for the cash flow. So that strategy is what we've been following for quite some time, and we'll continue to follow this strategy. Excellent, Karia. Thank you. Our next question Rogério Araújo, sell-side analyst, Bank of America. Rogério, we'll enable your microphone. Please go ahead. Good afternoon, Karia, Carol. Thank you for the opportunity. I have 3 points here specifically that I'd like to hear from you. The first is about the use of the elevating platform fleet. I understand that for 2024, the focus is to adjust the fleet rather than increase it. Can that bring incremental gains in terms of use rate, or do you believe you're already at a normalized level? That's the first point. And the second, if you can give us more details about the demand and pipeline for Yellow Line, how you seeing it now for the beginning of the fourth quarter, whether it's accelerating or slowing down, if they are clients who didn't rent before, they're leasing now, they had their own equivalents, or if you're fighting for clients who already rented but not from you. That's the second point. And the third is about M&A. I'd like to understand this idea for new segments of equipment different than those that the company operates today, or is it to work on someone who's very close to extract synergies? Well, okay, Rogério. So first, let's start with the fleet use. I think 2024, for light rentals, we do have a share that is projected for fleet increase. There is an adjustment for the mix. We'll continue adjusting the mix to seek productivity, to seek yield. So at the levels we have today for use rate, we do want to increase that during 2024. And seeing opportunities in the mix that are different from what's being demanded today, we're migrating to those types of equipment. So next year, the idea is to make acquisition of purchases of fleet with a bias for growth, and another share also to adjust our fleet or renew our fleet and so on. When we look at heavy rentals, the demand and our pipeline are very robust. I think it's been proving our thesis of the depth of the market. It's a dense, profound market. And we've been just over a year working on this industry, so we're just scratching the surface. We started doing a lot of cross-selling with almost 9,500 clients that we have for formwork and storing, elevating platforms, generators, compressors, to try and get them to rent our Yellow Line equipment. And there's a little bit of both. Of course, there's a lot more of customers who are not satisfied, want a company that will deliver more value in terms of uptime or service SLA. But there are other clients at a longer curve with this conversion of the buy to rent concept. We do that, but it's a longer curve in terms of a changing mindset. When we look at the M&A strategy, I think for now, considering our recent entry in the Yellow Line, we are preferring to focus on the assets we have today rather than, in the short term, seek to diversify an additional product portfolio. I think the idea here is not to bring on additional complexity, operational complexity to the organization until we're comfortable with all the value levers that we want to generate in our current products. So in the heavy rentals, we have both Yellow Line equipment and trucks to support our Yellow Line, but the idea is not for us to constantly seek, for now, additional M&A to increase the product portfolio. We'll do that further ahead, but whenever it is that we understand that this operational aspect is more mature and the value levers we want to propose to our customers. Excellent, thank you. Our next question, Guilherme Cambrai, buy-side analyst. His question is, I would like to understand the rental dynamics for the upcoming quarters, specifically in the agribusiness industry. If you could also talk about the CapEx expectation in terms of expansion for 2024. Guilherme, thank you for your question. We don't provide a guidance of our CapEx for the following year. I think Carol talked a little bit about our strategy for capital allocation with Fernanda's question. We should focus more on heavy rentals in terms of capital allocation for next year. And of course, we also have a very strong focus on agribusiness. Long-term agribusiness is very specific for some types of Brazilian agriculture crop sectors. What we're focusing are those windows of opportunities, and those windows of opportunity are between harvest, between crops. The beginning of this year, the end of this year, beginning of the next, are the main windows when there's a movement to replace providers or customers who are seeking to rent rather than purchasing. So, of course, we have a more robust pipeline. We're focusing in the generation of new customers of a bigger pipeline, but it should occur especially towards the end of the fourth quarter, beginning of the first quarter, and a little bit in the second quarter, the beginning of next year. I think there's a question from Mauricio there. Caria's microphone is off. Next question from Mauricio Hamani, buy-side analyst track. Could you please read my question? Good afternoon. Congratulations on the results. I'd like to understand whether the increase in investments over the last 2 years is already reflecting in a lower tax payment, either due to the tax credits or fast depreciation of assets. Has that had a positive impact in the company's cash generation this quarter? Carol, do you want to take this one? I think Carol's having an issue there. Okay, so Mauricio, yes, we've been making strong investments. PIS and COFINS tax, we pay 1/48. We don't pay all of it straight up, but according to the normative instruction from last year, we end up recovering 1/48. But with more investments, we do end up using those credits to improve our performance. The accelerated depreciation also of yellow line also brings tax benefits. We depreciate on average for 3-4 years on the heavy equipment. In fiscal terms and in accounting terms, it's about 11 years for our rental equipment. And that generates a positive impact. We're going to start this match in the cash earnings, the cash net income versus net income. This cash generation by quarter will have a positive impact. That's it. Thank you for the answer. Next question, Rafael Carvalho, buy-side analyst, CL4 Capital. Good afternoon. Could you please comment on IRR, where the yellow line contracts are being closed? Are you signing contracts based on the demand at the end, or the company that may decide to make any one-time acquisition of machinery in a scenario of falling prices? Hello, Rafael, thank you for your question. About the IRR, we calculate IRR for every contract that we sign,
It's calculated per contract, and we can do it two ways. There's either what we did during 2023 that was to purchase specific equipment for specific contract, and then IRR is already linked to the cost of acquisition of the equipment for that contract, or what we've been thinking as a strategy for coming months is to have a balance between more of an opportunistic purchase when we can get more scale and bring the best price here, considering a greater scale of equipment. Since we know our pipeline better, we have a robust pipeline of customers and machines for the coming year and the following years. Or we calculate IRR, as I said, based on a specific purchase for that contract when you have some type of equipment that we don't have in our inventory yet. I don't know if it's very clear on the second question, but throughout this year, considering the interest rates that's very stressed to the beginning of the year, we ended up buying a lot of ad hoc equipment. So now we're starting to see opportunities to negotiate packages of equipment since the curve is in a downward motion. And with that, we can use the best opportunities with our bargaining power with the manufacturers and purchase at better prices. So we're going to use that a lot for 2024, as I said. And of course, not only making advanced purchases, but also one-off purchases according to the contracts we sign. Thank you for the answer, Sérgio. We have a question here from Daniel. He's asking about our 51% EBITDA margin, whether it came as a surprise or if you were expecting that in previous months' quarters, and what we're expecting in terms of pricing and inflation in the equipment that we purchased during the quarter. Well, Daniel, we have been focusing a lot on margin improvement. We'd even said in the second quarter that we were seeing some effects of internal adjustments, focusing on the improvement of our relationship of G&A over revenue, and we're harvesting results for this quarter in 2023. And I think as for the pricing of equipment, we see that there are opportunities looking forward. What we want to use is that instead of buying according to how the demand appears, is to use our bargaining power, because we see that there will be opportunities for the equipment acquisition in terms of the price level that will be relatively better. But the advantage was relating it to your question. Since we've already closed some long-term contracts, the internal rate of return is locked, no matter irrespective of the price I paid. But looking forward, we see these opportunities of transferring that gain to our clients or improving our own internal rate of return. Thank you for the answer. Our next question, Marcelo Azen. Good afternoon. Congratulations on the results. What's the company's expectation for the Petrobras strategic plan for 2024 to 2028, and how can this impact the demand for Mills rental services? Marcelo, thank you. Of course, if Petrobras follows the strategic plan for its coming years, we should have very expressive demands in the light equipment rental for generators, compressors, elevating platforms, and even for our formwork and shoring business. A little bit less maybe for heavy equipment and yellow line, but there might also be some, but especially for light equipment rentals. So we are watching closely, looking for the opportunities in the Petrobras strategic plan as well. Thank you for the answer. In order to ask a question, you should click on the Q&A icon at the bottom of your screen and write your name, company, and language. When announced, a request to enable your microphone will appear on the screen when you should turn your microphone on to ask your question. If you prefer, you can type your question and ask the operator to read it. If there are no further questions, we now close the Q&A session. I'd like to turn the floor to Sergio Caria for his closing remarks. Please, Mr. Caria, you may go ahead. I'd like to thank you all for your participation and interest in our conference call. And I tell you that our Investor Relations Department is available for any further doubts and questions you may have. Thank you very much. Have a great day.